Hello and welcome. You're watching Business Today Television. I'm Tanya, Aneja. Well, if we talk about FY23, the Indian markets were volatile amid high inflation, aggressive monetary policy stance, and the Russia-Ukraine crisis. The year ended on a mixed note. Sensex gained 0.7%, while the Nifty 50 was down 0.6%. Now, talking about FY24, we started this year on a good note. Sensex reclaimed the 60K important mark. But will FY24 be a much better year for equity markets compared to the year gone by? To discuss this and much more, I'm going to be joined by a very special guest today. We have with us Mr. Rohan Mehta, who is the CEO and fund manager at Total Wealth. Thank you so much, Rohan, for taking the time out and joining us here on Business Today Television. I want to begin by asking you about the market outlook only. I mean, a lot has happened in the past 12 to 18 months with the war and inflation and many other factors playing out. So, what are your expectations for FY24? And also, do you see any new challenges that the market is expected to face in the new financial year?
Markets are good. Markets have done amazingly well, but if you can see, there are 19 months of underperformance which has happened in markets, and with every bull run, there is a big consolidation which happens, and with every consolidation, there is a new bull run which happens. I think so. Whatever has happened into the markets, the most beautiful thing what has happened is that people have started losing confidence in markets. There has been redemptions in the markets. There has been, if you see, the confidence has gone down, with the volumes has gone down, and with the accounts opening has gone down, and that is the biggest opportunity in the market in last 17 years. I have seen when market people lose the best confidence in market, that is the best time to invest in market. So overall, on the macro side, I think so the things are still pretty bit tricky. But if you
Okay.
see on the Indian side, the way India is performing is just resilience. The way businesses are doing is fantastic. I meet nearly about five managements every week, and the growth they are seeing is just unbelievable.
And also, Rohan, all eyes are now on Q4 earnings as well. So, TCS just came out with soft March quarter results, and revenues and margin both failed to meet the street expectations. So, what are your thoughts first on TCS, and also what are your broad expectations for March quarter earnings? I mean, do you see significant earnings downgrades than upgrades?
If you see overall, TCS has been okayish, because see, the level of the work they do and the level of the size they do is very hard to scale on that scale. And when the US and the overall the world markets are not at that pace, the impact is going to come. Still, a company like TCS only can manage that type of underperformance, still not underperforming to a very major scale. So I think so. Still, TCS or an IT company will take good 3 to 4 quarters, and then after that, the value will be there. Coming back to the quarter numbers, what you have asked recently, we believe that the expectation is extremely low, and the companies and the sectors which will outperform in this quarter is going to be the next year heroes and next bull run heroes for coming down. We see manufacturing and infrastructure to be our top sector picks.
Okay, and coming to the sectors only, I mean, which sectors are you extremely bullish on over the next 1 2 years, and which ones are you bearish on? And also among sectors, where do you want to increase your exposure for FY24? Any emerging themes that you are closely watching, especially at this point in time?
Yes, see, the interesting part is that every big bull run, there are new sectors which come. In 1980, 90, it was manufacturing. Then it came next 90s, it was IT. Then 2000, it was power infrastructure, and then it was chemical and consumption. And this time, we don't know what is going. What we are bullish is on is manufacturing. Manufacturing on a very larger scale is doing extraordinary good. See, our Indian GDP is made based on three things: agriculture, manufacturing, and service. Last whole decade, it was the the services which took over the GDP. Now we think that manufacturing will take over. infrastructure. In infrastructure, we look forward for chemical constructions, construction chemicals from equipment, cements, everything. And then small IT companies also we like. And the last we like is PSU. We feel PSU is extreme value, superb value. It is available in PSU. The day the growth start happens, PSU will be a migration from a private companies to PSU companies. And the sectors which we don't like, it is not that we don't like it, but they are not performing. We feel
Hmm.
that FMCG and consumptions are very highly valued. It will not
Okay.
perform. Chemicals will be a lackluster, and then pharma can see a revival, but still it will take its own sweet time.
Okay, that's the word coming in. And also, which sector is the cheapest in valuations according to you?
PSU. No, no
Okay.
doubt it is PSU. I think so. PSU is still available at 5 times, 6 times of its value. 15 years, nothing has happened into lot of companies. Companies like PFC, REC, Power Grid, SBI are available at throwaway valuation. I think so. There is nothing to lose out in discounters.
Okay, absolutely. And also, Rohan, Adani Group also continues to be in focus. So, are the valuations looking attractive in Adani Group stocks, especially after a sharp sell off that we have seen?
See, the biggest concern is that people lose confidence in corporate governance,
Hmm.
and people who manages person fund like us, who manages millions of dollars,
Hmm.
have not invested just because that we have lost the confidence of corporate governance. Now it will take a huge time to get back the confidence of corporate governance, and without corporate governance, honestly, the number doesn't matter. So, a lot of fund houses and lot of private boutique investment companies will shy to invest into Adani companies, and that is the reason I would not rather comment on what is the right valuation, but I would fear out to invest because we feel that corporate governance is somewhere sacrificed over the growth parameters what has been seen in Adani.
Hmm, absolutely. Okay. And also, what's your take on all these new age tech companies? I mean, is it the right time to now step in to take exposure like in these new age tech companies, especially after the amount of correction?
Yeah, yeah, you're very right. See, I'll tell you, we don't buy companies which does not do profits. So that is the reason we have not invested into our funds. But ask me, ask my daughter, ask a youngster. People are addicted to the companies of new age companies. My 6 year daughter knows that if you want to have food, you have to do a Zomato.
Hmm.
You can do an Ola and Uber, or you can do a Paytm, and that's a
Right.
huge thing which is made a dent into our using patterns. I feel the valuations are very compelling, very interesting. Maybe it will take still 1 2 years to get back to the profitability, but if an investor is listening and if they are ready to take a bet, I'll tell you an interesting point. In 2000, when Infosys and all this company came, people used to tell that you should only invest in companies which make smoke. So, Joe, any companies who does a manufacturing only should be invested. Computer business should not be invested, and that's how what is happening in new age IT companies. People don't understand the power of burning cash flows, and that is the reason people don't understand this new age how they have made a dent in the industry. But
Right.
overall, we believe that the valuations are compelling. It's a great buy.
Okay, valuations are compelling. That's the word coming in. And also, Rohan, we know that the RBI has taken a pause, but will it be a long pause followed by a rate cut from RBI, or do you see one more rate hike coming in?
So we before this RBI cut, we were very clear that it is not possible for RBI to continuously rise the rate, because see what happens is that your first indication of market economy going down is the rising of the interest rates, and then share prices comes down, and then commodity prices comes down, and then the reserves comes down. So this
Hmm,
somewhere
right.
the pause had to happen, and this the pause has happened. I believe we don't have more margin of more than 15 or 20 bips. If anywhere the economies go still slow down, but rather from a pause to a cut of interest rate, which must is much more possible in next 1 year.
Okay, absolutely. And Rohan, just one last question. Any mistakes that investors should avoid, especially in this new financial year?
I think so. There are three things or two things I would add, because I meet rather every day three to four big investors. I believe that, as we cannot cut our hair, the same thing, it is the expert thing to invest into the markets, because it's not a funny game. It's a very serious investing process. And if somebody doesn't know, put it into mutual funds, put it into PMS. Don't be the expert for yourself. And secondly, if you're doing for yourself, this is the best time to review your portfolio. Please don't forget that every decade, a new sector or new theme has made money, and people get hangover of the last theme and they invest in the last stocks, and then this stocks doesn't make money. So we have to be very open that which sector, which stocks are doing much more better. I'll tell you, in 2010 to 20, chemicals started after 20 years of rally and made
Right.
50 to 100x returns in just 6 to 8 months, 6 to 8 years. So I think so. We have to be open and don't get a hangover of last decade stocks which has done good.
Okay, that's the advice that is coming in from Rohan. And on that wonderful note, thank you so much for taking the time out and joining us here on Business Today Television. So, with that, let's wrap up this episode. But stay tuned for all the latest market updates.
If you like the video, do like, comment, share and subscribe.